Welcome to the Gordon Asset Management Podcast, a show for savers, investors, and entrepreneurs, helping you to stay informed, invest wisely, and achieve the unimaginable. Now, on to the show.
Welcome to the Gordon Asset Management Podcast. This is your host, Todd Zempel. For those who know me, Z. With us today, we have a very special guest, Megan Fielding. Megan is Senior Director of Responsible Investing for Nuveen, which is the investment arm of TIAA CREF. TIAA manages about $1.1 trillion with a T in assets, and roughly $37 billion of those assets are in socially responsible strategies, which is why we invited Megan to the show today. So Megan, welcome to the show.
Thank you so much. It's a pleasure to be here with you and all your listeners.
Thanks, Megan. Let's start at the basics. Can you describe for us what exactly is socially responsible investing?
Yeah, sure. So nowadays, really, there's been so much terminology entering the marketplace over the last, couple of decades. And so the industry has really migrated from what they used to call socially responsible investing to what we call responsible investing. And so what do we mean by that? It's really an investment approach that incorporates environmental, social, and governance factors. That the acronym for that is ESG. So you'll hear us talk about that quite often. But ESG factors are incorporated into an investment analysis, into the portfolio construction, into the ongoing monitoring of an asset class like public equity, with the objective of enhancing long-term performance, managing the risk of the portfolio, and creating opportunity.
Thanks for that summary, Megan. Now, you guys have been doing this since the 70s, right? So that's before millennials, before the quote-unquote woke culture. Is that correct?
Yeah, we started literally in 1970.
Wow. So what did it mean to be socially responsible back in the 70s?
Yeah, so back in the 70s, it was really, so if you think back in time, in 1970, TIAA, which had been set up really to help educators, teachers, various people working within academia, set aside funds for their retirement plans. So in the 70s, teachers, different folks associated with academic institutions started to come to their investment advisors, their investment managers like TIAA, to express their concerns around certain things. In particular, at that time, South Africa and the Vietnam War were major areas of concern. And so we started working with our investors around topics that we would now call, engagement. So working with the companies that we owned in portfolios that they were invested to raise awareness with the corporate directors at those firms, as well as to help shift behavior over time so that it would be more in line with the values of the investors of the funds that we were investing in, or we were managing, I should say. Also at that time, a lot of institutions were created to offer a forum or kind of an organizing body to aggregate those voices of investors so that the individual investor would be stronger in a group versus just, ringing up their investment manager and articulating their own special needs. So organizations like ICCR, for example, came about at that time. Our first product, so to speak, came to the market in 1990. And so, you might be sitting there thinking like, wow, what'd you do for 20 years? but the reality is, as investors were contacting their investment managers like TIAA, we were engaging with our companies to raise awareness, to try to start to affect change positively from, at that time it was really the S in ESG from a social perspective, as well as raising awareness around governance and the environmental issues. But the way portfolios were often managed in the industry were by taking things out. So it was an exclusionary focus. So an investor would say, I don't want to own Pfizer, for example, because they have a large operation in South Africa, and I'm morally opposed to apartheid practices that are dominant in South Africa. So an investment manager would take Pfizer out of a portfolio, but they didn't necessarily replace it with something. So what that led to in terms of performance was oftentimes underperformance versus their benchmark, called the S&P 500, which did have Pfizer in it. That's just one example, but this was kind of the ongoing practice. So in 1990, we, as well as a couple other firms, came to market to offer a social index fund that investors could invest in to get, quote unquote, the normal benchmark results without those industries that they were opposed to. So, in today's day and age, that might not sound revolutionary or more like, doesn't sound like a pioneer, but it really was, if you think about it. It was finally this idea that we can be proactive versus responsive, or just, doing negative screens to take things out of a portfolio.
Now, with socially responsible or sustainable investing, one of the reasons why it's so attractive to me is when you ask Joe Sixpack, maybe all they have is what's in their 401k. When you ask just a person that's not in the industry if they could take their retirement savings and invest in a way that is positive for change, would they do that? And 9 times out of 10, people say, yeah, I would absolutely do that. And the big concern has always been, well, if you do that, what are you giving up, right? Are you giving up performance? Well, the good news is, for the last handful of years, at least, you hadn't had to give up anything. So you could invest for good, but also have good returns. Can you speak to that?
So last year, 2020, really offered a lot of interesting data. If you think almost a year ago to March of last year, extreme volatility in the market. I'm sure you have a lot of stories that you could share in terms of your phone ringing off the hook, in terms of people, being concerned about all of the volatility that they saw in the marketplace, that they were hearing about in the newspapers and on the television reports, et cetera. But 2 things stood out. So one, during the period of volatility in March, April of last year, sustainable funds outperformed their peer group, so the non-ESG or the non-sustainable funds. And then longer term, they continued to do very well. And then over a 10-year average, if you're comparing, for example, sustainable equity funds to the S&P 500 or the Russell, they're really in line, both from a performance perspective and a volatility perspective. And something, that we talk about a lot in the investment management world is risk-adjusted returns, or Sharpe ratio. And there it's actually spot on with the S&P 500, and slightly better than the Russell 3. So thinking of your clients who say they'd even be willing to give up performance results, data both short-term and long-term suggests there is no reason to give up that performance. In fact, they can do equally as well as non-ESG funds.
I love it. I mean, you are making money while you are doing some good in the world, potentially. I mean, apparently I'm not the only one who loves it too. Per Morningstar, roughly there were $51 billion in flows into sustainably managed investment options in 2020, which was almost double that of 2019 and roughly a tenfold increase over 2018. So needless to say, I'm not the only one who's interested in this topic.
Yes, yeah, absolutely. And again, Morningstar has a lot of data publicly available on their website to help expand upon that.
Now, Megan, one of the areas that I have particular concern about is that when we look at the list of companies that have very high, quote unquote, sustainability rankings and things like this, a lot of the times all they're doing is outsourcing the nasty jobs to the third world country. Now I'm talking about oftentimes it's to the worst of the worst. communist countries, running factories that people are working for essentially slave labor type wages, forced abortions, suicide nets around the factories, just pumping out the nastiest of the nasty junk into the atmosphere. How do investment managers reconcile this?
I mean, certainly I can't speak for all investment management firms, but I'm happy to share our approach here at Nuveen. There are lots of different avenues to create a fund. And so there's active management, where you're literally looking at every single security that goes into a portfolio and you're actively managing those positions. And then another area might be more quant-based or more index-oriented. ETFs, exchange-traded funds, for example, are a big area that a lot of investors look at to invest their money. In both cases, however, you're establishing criteria that starts that process. So I would call that the initial universe creation. So when it comes to our ESG funds, regardless of if it's an active strategy or a quant-based index-oriented strategy, it starts with that universe creation, and that is really around ESG criteria. So what we're looking for are ESG leaders in their respective sectors across all industries, and across the entire region of what that fund is designed to do. So in the case that you've outlined, emerging markets, for example, that holds true in emerging markets. So who are the ESG leaders? And when you peel that back to look at the analysis around ESG leaders, again, it's specific to the sector. So for example, I think you described really kind of a manufacturing company, with a supply chain. And so the analysis that takes place is looking at that supply chain. What are their labor practices? What are their how are they treating their vendors? What is their use of water? How are they sourcing water? How are they treating, water once it's already contaminated, for example, through the manufacturing process? Are they dumping it out into the public system, or are they recycling it, cleaning it, etc.? So all of those things are looked at. These are material ESG factors, and in combination, they help to assess that corporation or that company around their practices, which establishes what we would call an ESG rating. So what does that look like? How are they performing from an ESG leadership perspective? And as I mentioned earlier, when we design our strategies focused on ESG offerings, it starts with that ESG universe creation, where we're looking at ESG leaders by sector.
One term that's started to come up more and more is greenwashing. Can you explain to our listeners what exactly that is?
Yeah, greenwashing. So greenwashing is, I think, a fancy term to say like marketing spin, right?
Right.
So several years ago, particularly, I would say 2018, 2017, little by little, more and more investors and asset managers started to recognize the value of ESG, that it had shifted really from this values-driven investment orientation to having attributes in terms of accomplishing alpha for a portfolio, so outperformance, and or it was extremely useful tool in the risk management of that portfolio. And simplistically put, if you have more information than less information, will you hopefully do a better job managing your assets? And I think it's, we'd all say yes. So as the industry was really recognizing this, a number of firms kind of came to market, put their funds together. But also what started happening, or at least started to get exposed, was that some funds were editing their prospectuses and adding in the terms ESG into their prospectus to notify investors that they now had an ESG fund. And so again, you can have the best language ever to describe your work, whether it's in your brochure, your prospectus, but it really comes to peeling that back and doing the due diligence, which is why the work of you and your team at Gordon, it's so important, because you do spend time with asset managers and really understanding what they do, and that's invaluable. But so greenwashing is really the term that, it looks like a green or a sustainable fund, but it's just sort of splashed with the right, look and feel to help you think that way. It doesn't necessarily mean it's true. So it's, as I said, it's kind of marketing spin. Kind of the typical would be the glossy brochure, and it's got windmills on it and clean beaches, and it paints this beautiful picture of a phenomenal fund that most people, they'd be looking to sign up as soon as they saw those images. But it's peeling it back, as I say, and really doing the due diligence and understanding, is that a verified and authentic process that is taking place with that investment manager for that strategy? Are they really implementing an ESG strategy? What is their risk management process? I would also throw an engagement process. What are they doing once they own these companies to continue to forward best practices around ESG at those companies in which they're invested? Just last year, Morningstar, on average, their average category, 3 out of 4 sustainable equity funds beat that average, or 25 of 26 ESG equity index funds that they kind of follow. So there's performance of sustainable equity fund beating, quote unquote, the average fund, which is again the non-sustainable fund. And that sounds exciting, but again, from a diligence perspective, it's important to dive in and look at what those funds are and how they're actually investing, not to assume because the brochure says that, or even if they're part of a ranking that says they did this well. Really doing that diligence is so critical.
Yeah, if I had $1 for every time I heard a wholesaler come into our office and tell us that, oh, well, we've been ESG friendly from the get-go. There wasn't a term for it previously. It seems like a lot of folks are just, like you said, using the marketing now to hop on the train. Maybe they'll add a sustainability page to their website. Maybe they, tweak their logo so there's some green in it now. But it's definitely become a big marketing push for many companies and asset managers.
It doesn't mean that it's not authentic at some. It again just comes back to doing that additional due diligence, which is required really of any investment that anyone would be going into.
Now let's talk regulatory. When it's a personal account, a brokerage account, not a retirement account, people can invest however they want, right? But where the government and Department of Labor specifically have a little bit more oversight is within retirement plans, 401k plans. Now, late last year, the Trump administration, the Department of Labor under the Trump administration really shocked everybody and said, they put out a piece of guidance that said you can't use socially responsible metrics for determining whether or not a fund is suitable for a retirement plan. Now, under the new administration, that rule has been scaled back and potentially is up for debate at this point. Can you tell me where we are from a regulatory standpoint?
Yeah, I think you summarized it well. The Biden administration is looking at the rule that was passed in early November by the Trump administration or by the DOL, which, over the period of, from, 4-month period from when the DOL did accept letters, from the industry, asset owners, asset managers, service providers, in response to their proposed rule that came out in June. It was a very quick turnaround, but one of the notable changes from the proposed rule to the past rule was that they did remove the terminology ESG from the ruling. They still, are focused on pecuniary or material items to ensure that retirement plans are only selecting those fund choices that are driven by investment purpose versus anything else. And so what I would say over the review period, what transpired was a lot of concern around, does the DOL understand that ESG is a reason for investment? That is an investment motive, that ESG can contribute to alpha, can drive alpha, can manage risk, can create opportunity, can create risk management opportunities, I should say. And so by removing ESG, perhaps that was the DOL's recognition that when they formulated the proposal, that their understanding of ESG was rather outdated, to say it mildly. But I think the Biden administration is really taking a close look at, is the rule, even written as it is today, still confusing? Does it still, if you go through a checklist, does it really change anything year over year over year from what the prior rule was? And most people would say the only big change that it's made was with the TIAA section, right? So, which for the average retirement plan has been less of a concern. So, and I think, based on early days now, but their focus, immediately day one, getting back into the Paris Accord, recognizing climate change and the severity that it presents to not only us as a country, but us as a global society. I think it bodes well for an environment that, again, from an investment-driven lens, that bodes well for ESG in this environment.
Yeah, I totally agree. You go out and look at the World Economic Forum, the Fourth Industrial Revolution, Build Back Better, potentially opportunity for green infrastructure building. I think that ESG absolutely presents a very interesting and plausible investment thesis. And we saw that so far this year, where it seems that ESG is continuing to perform very well.
I was just going to say, you mentioned the environment, and certainly the Biden administration is very focused on, taking a close look at the work of the EPA, and as you know, some of that had been sort of curtailed over the prior 4 years. So I think there's promising early indications that more focus will be on legislation and support for an environment to work for all, which from an investment perspective, I think offers even more opportunity.
Now, Megan, one of the questions that I get a lot is there one common set of rules for what determines what is socially responsible versus what's not? I mean, what's socially responsible for one person may be completely socially irresponsible and reckless for another person. Who makes the rules on this?
Well, a couple things come to mind. One, the United Nations Principles for Responsible Investment. It was established in 2006, and the acronym is UNPRI. And they are really the leading, what I would call, voluntary investor initiative around responsible investing, which includes ESG. And they have 6 principles if you go to their website, one of which is around ESG integration. So there are asset owners, so investors, and then there's asset managers who choose to become signatories of the PRI. And so we, for example, are a signatory, and we have been since 2009. And I'm just looking. So there's over 3,000 signatories at this point, which amounts to over $100 trillion of assets collectively. And so it's an opportunity, I think, for investors who truly say that they're investing with an ESG lens or with ESG criteria to demonstrate that. So on an annual basis, there's an opportunity to complete modules that offer transparency around the work that's taking place at your organization. And it's a very detailed process. It takes several months to complete all of these modules, and then you submit it, and then you and PRI take several months to kind of assess that. And then they give you a scorecard, which is publicly available. So I would say that's probably one of the leading kind of organizations to help frame the work that's taking place. From an investor's perspective, it's like walking into Baskin and Robbins, right? There's so many different flavors of ice cream. With investing, there, as there's so many different styles and ways to implement those styles of investing. And the same holds true with ESG and responsible investing. Again, going back to the due diligence, I know like a broken record, but it's really important to do the due diligence to ensure you understand what the manager is doing and to ensure that coincides with the needs of the investor. But there's a number of other organizations that are out there. There's a group called USSIF, ussif.org, I believe is their website, where they have more information around all of their, around the industry itself. Every 2 years, they publish something called the Trends Report, where they go out and they interview, they collect research on what investors are doing in this space and what asset managers are doing. And they show, for example, the trend in aligning assets in a socially responsible way or a sustainable way. So over the years, it's gone from 1 out of every $5 to 2 years ago, it was 1 out of every $4. And now the results show that it's at 1 out of every $3 here in the United States under professional advisement. So with an advisor, is aligned with some type of responsible investing approach like ESG or impact.
Well, Megan, thank you so much for joining us today. You provided a great baseline education on responsible investing for our listeners. And as things develop, I hope that you come back and share more of your insights on this space.
Oh, I'd be delighted to. I think this year is going to be a very exciting year, given the change in the White House, the focus on ESG, the focus on climate and the environment, and also really the focus on inclusion and diversity as a society. So I'd be more than happy to come back and talk about that.
Thanks, Megan. And if anybody would like more information on Megan or Nuveen, you can visit their website, nuveen.com, or you're always welcome to reach out to our firm at wealthqb.com. So thanks a lot, folks. We appreciate it. Have a great one.
Information in this podcast is presented for educational and entertainment purposes only and is subject to change without notice. Opinions expressed are those of the participants and don't necessarily reflect those of Gordon Asset Management, LLC, its producers, hosts, or guests. Information presented should not be construed as tax, legal, or investment advice, or a recommendation or solicitation for the sale of any product or strategy. Listeners are encouraged to seek advice from qualified professionals to determine whether any information presented may be suitable for their specific situation. Investments involve risks. Neither Gordon Asset Management, LLC, nor its podcast participants shall be liable for losses resulting from decisions based on information or viewpoints presented on this podcast.